Welcome, everyone, to another week of the None of Our Businesses YouTube show and podcast, where we talk about weekly events in the news from an accountant's perspective. Not just one accountant, but as always, three accountants here today. With me is Charlie Zigman.
Hi, everybody.
And AJ Wheeler.
How's it going?
Hey, guys. It's been a good week, been a busy week. Let's get into it. What's new in the news that we want to talk about?
All right, so I found an article that I thought was good to talk about. It was in The Economist, and it was called During the Pandemic, a Digital Crime Wave Has Flooded the Internet. And so what the article looks at is, as we've gone through this coronavirus pandemic, everything is changing, and a lot of people are shopping online more than they were before. And as businesses try to change their methods to selling more online, what they're finding is that they're the target of new phishing attempts. And I say phishing, PH, as in a person trying to elicit you to give them your password or to gain access to your system. And so what's happening is that the FBI has found a 76% increase in these types of crimes since the stay-at-home restrictions started to happen. And so businesses are trying all these different things to try to not to have these kind of problems. And Interpol, the international policing body, found that these same things are happening internationally as well. So it's a problem that's happening in other countries and in the US. And so one of the main methods of attacks has been basically on individuals trying to, like I say, get their password. But one of the things that the article found that was interesting is that a lot of the attacks have been shifted towards larger corporations because they feel like they're better targets for social engineering and trying to get people to, give up the info. And so I guess I wanted to get your guys' take on sort of what companies can do to try to protect themselves from these types of from these types of issues, or what they can do to be proactive about cybersecurity, given that that there's a big increase in this type of crime.
Yeah, I think when I read this article, I was thinking that I guess it wasn't surprising to me because with the pandemic and everybody being home. Of course, people are able to answer email and phone much easier now because, if you're not working or you're not involved in something, you probably have more spare time. But I was kind of interested in the fact that the increase in the cyber attacks was up. I was thinking, in fact, one of the companies I work with, one of their vendors had a cyber attack happen to him. I got a funky looking phishing email from one of the vendors at this company or for this company. So I've actually seen it myself. And I think probably you asked, what can businesses do to try and stem this? And one of the things you touched on in the article was, this social engineering to try and crack somebody's password or something like that. More often than not these days, a lot of these phishing scams or cyber attacks is done, almost person to person. It's not necessarily maybe a piece of software that gets this accomplished. They need a person to be able to get into the organization's email or into that person's email or password to be able to access bank codes, such and such. So I think probably when we're talking about frontline defenses here is having ongoing training to a staff, if you're running a business, keeping the staff up to date on what to look for, how to make sure that, the email that you're opening, or if you're clicking through a link or downloading an attachment on an email, that it's from somebody that's legitimate, double verifying email addresses, that they're not funky, that it's not irs.gov.uuaa.cc or some weird address or something when they're asking for these, when they're asking for information. So I think probably, you can buff up your cybersecurity apps or anything like that, but it does you no good if somebody already has the keys to the kingdom. So I think being able to keep your staff trained to what to look out for and, staying on top of the trends in that are probably, especially if you're running a mid to big size company, is probably should be a forefront of what you're thinking about.
Yeah, I think, when it comes to clicking on things like we were talking about, I think confirming, when in doubt, make sure that you know who it came from, and not being shy about confirming with somebody that they're the ones who actually sent you something, and that it's clear where it came from. Because I think, I've seen that. I've had emails sent to me that that look like they're coming from an official source. They're coming from a vendor or from a customer or from a counterparty or somebody that I might presumably know, and asking me to click on this or click on that. And I always ask, I mean, I'm always thinking in my head, was this an email I was expecting to get, right? I don't just like take it and then start clicking on things. I don't assume anything about the email that I received, that it actually came. I don't assume that it came from who it said it came from necessarily, particularly when it's asking for me to click on this or that. And I've noticed kind of perhaps a scarier version of this is I've noticed in the last couple of weeks that I've been getting texts on my phone that are like this as well. So I got a text this last week just saying, and it used my name, my first name. It said, "Hey, Ty, there's a parcel we've been holding for you. Click on this link to claim it," or something like that. And it's like, so, you think about how much they somehow know about me in terms of my cell phone number, my first name, to try to inspire me to click on something with my phone. So I think they're getting sophisticated, and to be careful.
I think you guys are right on, and I just want to take a chance to, because AJ, you were talking about how you had seen this in some of your clients. I had seen kind of a new thing that I hadn't seen before, which was that one of the clients I work with is a law firm, and basically what had happened was a law firm that they work with, so another unrelated one, but just an affiliate kind of a deal, had separately been hacked, and that firm had sent emails back to the original firm basically saying, "Hey, we have an invoice we need you to pay." And so it looked very legitimate, came from a source that was trusted and somebody that they knew, but it turned out upon further investigation that it was, like you said, one of these elaborate type of cyber crimes where they had hacked one, and then instead of stopping there, they said, "Okay, well, what can we do with this domain that we've hacked? We can try to elicit, payments." And so, yeah, I think you're right on, Ty, about not being shy about verifying with the party, because that seems to be, when I think about that challenge, it's like, how could you really stop that other than calling each time? And so, yeah, I just thought it was interesting.
Yeah, and we see this a lot. I'd point out that I see this a lot with clients that are in the venture-backed space and the startup space, where they're high flyers that are in the news. So, I mean, if you're in the business journal of your community, or otherwise in the press for having raised a bunch of money, and in that article it might cite who the CEO is and the CFO and so on, you get there's sophisticated schemes where the CFO then gets an email from somebody who says that they're the CEO, and they're using the name, and they've spoofed the email address, and they say, "We need you to transfer X dollars today to this, to this account." And, and so I think any time that you are in the spotlight, you have to also anticipate that the volume and the sophistication of some of these attacks are going to increase if you've been highlighted somehow in the public. Certainly, if you haven't been highlighted in the public, that's no reason to let your guard down. But I think there is a certain amount of protection and a certain amount of anonymity, right? So there's a paradox of the fact that in business, you want to be well known, but the more well known you are, the more likely you are to be hit with this kind of stuff.
And I might note, for any of our staff accountants that are trying to pad their salaries out there a little bit by doing DoorDash or Uber Eats, I actually had a acquaintance that got hacked through the delivery service. So they were on a delivery and supposedly got a call from Uber Eats or whatever the service was from, and said, "There's been a mistake, or there's been a problem with your account, and we need to log in and fix it for you." And so essentially they backdoored this person's account and was able to deduct all the saved tips and mileage out of their account, and had it siphoned out. So I think for everybody to be aware, a lot of people have a lot of spare time on their hands right now, especially scamsters. And I think, it's happening at all levels, I think, just to be leery of it while you're out there.
Totally. And that reminds me of just one more that I had heard about, was just that even we had done a thing on the podcast a while back where we talked about how Zoom meetings had been a target, and that people were getting into Zoom meetings that they weren't invited to. But the article talked about how there's a web security expert found a way to crack Zoom meeting passwords, basically. So even if you've taken steps a lot of times that's not even enough. They said like in a matter of minutes, it'll try all 1 million passwords that you can do. And so, yeah, just be careful out there, everybody.
All right. So my first article for this week is actually comes from something that Donald Trump had passed recently, or had basically put on as an executive order. And what it was is he, on a campaign stop, he basically made the ode that he was going to permanently terminate the payroll tax and didn't offer any other revenue source. And so there's a chief actuary that actually said that, offered a prediction in a letter that said that if that were to happen in January of next year, where this payroll tax would be cut out completely, that the disability insurance trust fund would be exhausted by the middle of 2021, with no ability to pay disability insurance payments thereafter. And for the main Social Security, this is a funny name though, Social Security Old Age and Survivors Insurance Trust Fund for retired workers, they predict that the reserves would be permanently depleted by the middle of the calendar year 2023, with no ability to pay thereafter. So it's kind of a partisan article, but I was just, and they go on to say that even if reelected and he tried to do this, he couldn't permanently terminate the payroll tax cut without unilateral approval from both House and Senate. So I feel like the article might have been written ahead of time, but I found it kind of baffling that the trust, that is set up for both disability and for the old age Social Security, for lack of a better word, would be exhausted that quickly. So I'd kind of like to get your guys' take on this.
Well, yeah, I think that's the same kind of thing that hit me about it. I mean, the rest of it, there's a certain amount of clickbaitiness to this, and there's in the sense of, you said it exactly right. I mean, what the actuary was reporting is that revenue source, without it, would cause without some kind of supplemental or different kind of funding, the trust fund would be exhausted, which, then you can look at that and take the next step to conclude, well, does that mean that benefits won't be paid out? But I would say that's actually a secondary question, because, the country has all kinds of options in terms of how to pay benefits, even if something like that were to happen. Not advocating something like that should happen, but what I'm referring to as the clickbait of it is the articles and the newscasters who have started this discussion by saying Social Security payments won't be made if the if the payroll tax is cut. I mean, that's jumping to conclusions a couple of steps down the line, and so it's like, yeah, that's one possible outcome, but it's not a foregone conclusion that the entire path would lead to that. But in any case, in any case, what you said at the end there is kind of what caught my attention, is that just exact point that, yeah, the fund could be exhausted that quickly. When we think about the statistics that have come out regarding the economy, and that most people are living paycheck to paycheck. Most small businesses are living paycheck to paycheck. And in fact, the Social Security fund is living paycheck to paycheck. So that's, it's a universal truth of the United States of America. That's how we roll here.
Yeah, I mean, I've been hearing about Social Security is supposed to run out of money. I mean, basically my whole life I've been hearing that. And so, and we all know, like as accountants, that when you start to do these kind of disaster scenarios where you say we're just going to turn off revenue and kind of make a statement about what will happen, it's like, that whole organization is scaled up to the size of having that in place. And so it's kind of a ridiculous notion to assume that would then get pulled out and nothing at all outside of that part of the equation would change. Just seems naive. And so, yeah, I agree with you completely. But, I'm no more or less scared about Social Security than I've ever been, because you can only be told that you're going to run out of money so much before it starts to lose meaning, really.
Well, and I think it's worth noting something that a lot of these probably articles or pundits skim over, is there's only two ways to pay for something in government. Either you tax people more or you spend less. So, I mean, those are your two options, I guess. There's no selling products or something like that when you're a government. You get tax revenues or you decrease your spending, one of the two. And so, but like you guys said, even if those trusts run out, there's other I guess, other buckets to pull that money out of in the government. It's not as quite as, doomsday that they make it out to be as it should be. You got another article for us, Charlie?
Yeah, I do. So I've got one about. I found an article in a website. Now, bear with me on the name. It's from boardpanda.com, but it's an article about. There's a company called Gravity Payments, and there's a CEO of that company called Dan Price. And basically, what happened was that he was at a time he had been in with the company. He had started it and had been with it for a very long time and was making like $1 million a year. And had a bunch of feedback, at least according to the article, from his employees saying that they weren't able to do the things in their life that they wanted to do because they didn't make enough money and they were scared about bills. And so what this guy did to try to solve that is he said, I'm going to take the entire company and move them to a minimum salary of $70,000 a year because, among other reasons, but one of the reasons he gave was that he had read an article about happiness that said that once you're not worried about the major things in your life, like how are you going to eat, how are you going to live, that then frees you up to focus on other things and be a better employee. And so this article basically takes a look at how he felt that change has impacted his company since he's done it. And so basically his takeaway was that his rate of home ownership went up tenfold within the company. So a bunch of employees went out and bought homes. The rate of starting families was up about the same by about tenfold as well. Retirement contributions were up by double. And so I guess as I'm looking at the article and thinking my way through it, if you really buy into this kind of idea that the floor should be 70 grand or some number higher than minimum wage, I kind of started thinking about, well, where does that really fit? I mean, if you believe this, should minimum wage be some number closer to 70 grand, or is that too close to some other political ideology for you to really buy into it? And so I guess I want to get your guys' take on whether or not you buy into this idea that happiness starts at 70 grand.
I mean, I don't know. I have heard that from other like multimillionaires that they were happiest when they made like in that $100,000 to $200,000 range because the amount of work and effort and stress that went along with that amount of money was manageable. And as they increased beyond that point, they felt less happy and more stressed, and there was more weight on them, I guess is the way to say it. I will say from personal experience that probably $70,000, if you're in today's money, is probably where you can start to like be comfortable, I guess, like, and not, we just talked about living paycheck to paycheck, where you would have the ability, not that everybody does that makes that amount of money, but you would have the ability to start saving and be modestly okay with, an emergency or something like that. But I guess the thing that caught me, and they've done a bunch of articles about this gravity payment guy and how and the outcomes of him decreasing his salary by so much and increasing everybody below him salary so much. What I will say is the optics of this within the company are probably the biggest, bonus or something to highlight, I think, because I think we've even covered in previous podcasts the amount of people that stayed, are happy to work there, feel like they're being heard, and all the things down the line that you would want. Engaged employees, all the things down the checklist of things you would want employees to be, they score high marks on. Now I haven't seen financials for the company. I don't know. I've not looked into it any further than reading into it, so I don't know if it's a good business decision. So I can't speak to that. But from a morale and like a company culture kind of standpoint, I would say it's admirable, at least if what they're reporting on is true. The satisfaction of the workers and such.
Yeah, I have a lot of comments I can make about this. I would start with, I don't necessarily see this as political unless it goes to the state of saying, well, because this works for one company, we're going to try to force it on all companies. I think the business decision of one company, or if it becomes a trend, the business decision of many companies to do something like this it's a business decision. And in turn, he's reporting that it's actually been a profitable business decision for him. And that doesn't, I like that story So I want to believe that's true. I guess I'm always a little bit skeptical as an accountant of whether things are exactly as people say they are, but I like the story that goes with that, and it's along the lines of the way I'd like to believe the world works. Um, I think, I mean, the question you actually asked at first though was whether there is such a thing as a happiness wage, right? Um, and I think there were actually there's been a couple of different research studies that the one that he was relying on, and there was another one that kind of got to the same kind of conclusion. So I'd say that part of it, I believe that there is a happiness level in general. If you were to average things out, I don't know if we know exactly what it is. Is it really 70,000 or is it some other number? I don't know. But I think that makes sense. I was having this discussion the other day with somebody about the adage that money doesn't buy happiness, and my point is, well, and I cited this study and said, well, that's not quite true. It actually depends on where you are on the curve. And I do believe this to be the case, that money does in fact buy happiness because it buys peace of mind and stability and comfort and things up to a certain level. And so I think there is a curve at where there's some equilibrium point at where you have the peace of mind and stability and the things that make us happy as human beings. Money has bought you that. And then beyond that, money, the extra income that you have may not actually make you more happy. That's what the research indicates when it's honing in on this kind of number like 70,000. And so that totally reconciles with my anecdotal world experience. So I want to believe, and I do believe that to be the case. On that, so that's my thought on that particular point. But then on the, another point about this that I'd make is, I don't know though that setting a company-wide minimum wage at a level, at this so-called happiness level, works across all companies in all industries. I mean, I don't know the dynamics of his company, but I can imagine that there are some technology-based companies where the entire workforce is all fairly skilled. And so it's not, you're not hiring people who are low skilled in that particular workforce. And I think that, and maybe you're not necessarily training people. Not all companies are training grounds either, right? And so if your company's not a training ground and you are typically hiring people with a set of skills, you're basically letting other people do the dirty work of paying the lower wages, and then you're like picking the cream off the top of that, and then patting yourself on the back because you have a minimum wage that is 70,000 or higher, right? But if you're not actually doing the work of training fresh college grads or even high school grads into a worker that can add value at that rate, you're not actually doing that kind of work in your business. I don't think it's necessarily fair to compare yourself in that way. And so I think I do wonder about that. I think that another way to say that is, not all jobs and not all roles are by design designed to be a livable wage. Some roles and jobs are training grounds, and by that virtue, they're not designed to be livable wages. And I also think that's a truth about life that, if we want to make every job in America a livable wage and none a training ground, I don't know exactly where that goes. I don't know how feasible that is, and what that would mean about the dynamics of the workplace if that were the case.
I can speak from personal experience. We were talking before the podcast about when I was younger in my career path, when I was first in high school and in college, I worked in the food industry. And if I was making $70,000 in the food industry, it would have never motivated me to do anything more and, further my career to be able to provide for myself and my family. So I think there is an error to that where there's some, if everybody just made $70,000 as like a janitor or, and not that these aren't essential jobs, but, like as a fast food worker or working in the food industry, I think a lot of, some people are just motivated to do better, but I think that motivation for some would be lost, and that like life, for lack of a better word, life level up wouldn't happen for some people.
I think you guys are totally right, and I think Ty, you were wise to be skeptical because while I don't necessarily have a stance on it, but I have read other articles that suggested that perhaps this move had other factors at play about different suits that person was lawsuits that person was associated in, where maybe this move had an ulterior motive. The other thing I wanted to share is that just on that point of whether or not money can buy happiness. The comedian once said that, have you ever seen a sad person on a jet ski? And I thought about it and it's like, you never have. Nobody ever has. So can money buy happiness? We don't know, but it seems like it maybe could. So
the piece of the article that I want to believe is how things could work is the idea that if you're the owner of the company or you're in the top executive ranks of the company and you're pulling down, and I think there's some organizations like this. There's some small businesses that are like this. There are some entrepreneurs that are like this. There's some industries that are specifically like this, where there is this huge disparity. Like you've got the top that makes a lot, and then you've got the workforce in the company that that just doesn't, right? And so, if you ask the question, is there actually any value in equalizing that to some extent? My gut, what I want to believe is the case, and what I'd like to read into this story was happening with some of the success that they're having is that if your business really does depend on the quality of your people, which we always say in business, right? So if it really does depend on the quality of people, and if you are paying a higher wage across the board, maybe as an owner, entrepreneur, executive, or whatever your role is, where you're making the bigger money at the top, you're making less temporarily in order to provide more cash compensation to the rank and file, to the team. And maybe that allows you to upgrade your team in a way that the overall company makes more money, right? And then there's more for you to get in the long run as the entrepreneur and the executive and whatever, right? And I think, I guess my intuition about that, which is kind of how I've run my professional life and business, is that I'd rather make a smaller percentage of a really large pie than a big percentage of a small pie, right? And I think that often in a lot of small businesses in some industries, that's what the owner and the entrepreneur group is really trying to do, is that they've got a fixed smaller pie and they're trying to squeeze a large percentage of that out for themselves and leave only what they absolutely have to for the rest of the team in terms of compensation. If I can grow the pie substantially by having highly committed and qualified people because I pay more, and maybe my percentage of that bigger pie is less than it otherwise would be, my feeling is I get more in the long run. And I think that's kind of a choice because actually the math may work out that it's about the same. The math may work out that I run a large pie and get a smaller percentage of a large pie, and a colleague runs a small pie and gets a bigger percentage of that small pie. And between the two of us, we both kind of have the same take home. And so then it's just a question of, well, which one would I prefer to be in? I personally would prefer to be running the larger pie with more people, or with people who have higher compensation levels or aren't stressed out for the amount of work. I think about this in the context of like accounting firms, of course. That's the way I always think about these things. And, it's just like, well, yeah, I mean, you can, I just think that that me taking a smaller percentage of a larger pie just feels more fun and easier than trying to take a big percentage of a small pie, always grinding out as much as I can get out of the smaller pie. So yeah, I mean, I'd rather have well-paid colleagues that I work with and we grow a bigger pie, and that may mean that I'm not getting proportionally much larger compensation than everyone else on the team, but because the pie is bigger, I'm gonna get my nut. I'm gonna get what I want, and so I'm happy with that. So I kind of read that into it, but I think we read into scenarios what we want to see sometimes, right? But I read into it that way, is that, yeah, this guy gave up on some of his compensation in the short run, but he's growing the business substantially, and at the end of the day, he owns the business, so he's going to get his in the long run.
Well, and not to mention like the PR move associated with it as well, because especially with the first one to do something major like this, he's seeing the benefit of the public spotlight on him for that decision, which is something that you wouldn't see in all the future people who, maybe take that same approach. All right, got another article we can do, AJ?
Yeah, absolutely. So this one is actually was an article on Yahoo. It was really short. It's organizations are increasingly turning to accountancy firms for strategic business counsel and financial advisory. Sage survey says. So actually, the article itself kind of breaks up some of what was said in this report. But I went ahead and downloaded the report, and I think that's probably where the meat of what we should talk about lies. And it was interesting to see. Now, this is from Sage, an accounting software provider. So a lot of it is aimed at like digitizing and, AI, your accounting system or technologies to help you improve efficiency. But what it was basically a survey of about 1,000 accountants, and it got their feedback and kind of broke it down. So I'd like to go through some of the numbers and get your guys' kind of take or spin on it. So one of the big ones was that, and I highlighted it here because basically what they're saying is 87% of the respondents agreed that clients are expecting more flexibility and better service levels from their accountants, caveat, without an increase in their rates. So surprise, surprise, clients want more for the same price. A couple other ones that were interesting was the new generation. So 84% of the survey respondents agreed that a digital native prospective employees from younger generations have progressive expectations, attitudes, and talents that will need to be reflected and nurtured by accounting firms if they hope to attract them. So I'd love to get your guys' take on that. Client expectations was another thing that they kind of touched on. So 82% of the accountants in the survey agreed that clients are demanding a wider service offering, regardless of any technological or societal factors. So this, they're talking about they want to see more from their accounting firm, I guess, and they want more services other than just the traditional tax and audit or bookkeeping skills. One of the last ones we can touch on, and there's some more if we want to ping pong back to it, but one thing that I did find surprising, and I'm kind of questioning whether or not this is correct, because most of us have worked at a public firm, but I found it kind of surprising. 74% of the respondents said that they formally reviewed their business practices in the last 12 months. Maybe I don't feel that surprised about it because this survey, of course, happened, I think, last month or so. November. Yeah. So in 2020. So maybe they have, maybe 75% have reviewed their business practices because of COVID. But I think before that time, probably we wouldn't have seen such a large respondent to it. So I'd like to get your guys' take on just these few statistics from the study. If they maybe got something wrong you can think of, or if there's something in there that, kind of was unexpected.
I just want to say from the standpoint, the one thing I really agreed with is the idea that clients are asking for a wider range of services from their accounting providers seems like something I've definitely experienced, because it's very difficult to scope what an engagement is going to look like until you're at the end of it. And you always find that once you get into it, you're finding that they actually want more and more, and it often branches out into other topics that you maybe didn't foresee when you were first getting the engagement set up. And so I've seen that as a trend. I don't know that it's necessarily gotten worse, but it seems like that would make sense to me. Other than that, it seemed reasonable. I agreed with most of their points about what's changing. I was a little surprised about what percentage of the businesses had revisited their practices, because it feels like that almost seems like it should be 100%, especially now. But yeah, I'd like to get Ty's take on that.
Well, I think that these kind of surveys are, it's all about the types of the questions that they choose to ask and the way they ask the questions, right? And there's always this kind of, I think that, the survey seems reasonable and provides some good information there, but I think that the authors of the survey are kind of part of that, are part of our industry that is on this bandwagon of wanting to promote and sell to accounting firms that they should use more technology. No surprise, they're a technology firm that does this survey. That they should be using more technology, and that they should be developing technical and technology expertise and other kinds of services, and expanding their service offerings, because that's what clients really want from them. Is they want their CPA firm to do a wider variety of things. And I think that's a narrative that is being pushed in the industry. I think, I don't know that it's necessarily not, I wouldn't say that I don't think it's true. I'm double negative there. So I'd say, I'm not saying that it is incorrect that your average client may want that option from their CPA firm to do a wider variety of services. But I think, obviously, I have my own stake in this, because in our firm, we've chosen the selection of services that we offer. We don't do traditional tax or audit services. We provide CFO, controllership, outsourced accounting type services. And we're making the bet that clients will appreciate our experience and expertise and ability to provide service delivery in that's unique and different from a one-stop shop that does it all. And so I think that that's what I believe. Having been a partner in a public accounting firm with a tax background, I mean, we could fire up a division to do tax returns if that's what, if we really believed that we needed to do it all. But I just don't believe that. And so I think that's a part of the narrative that I'm resistant to, is this idea that a CPA firm, a traditional CPA firm, needs to do it all, that they need to do what we're doing, which would imply the inverse, that we should be doing what they're doing. And I don't think that's the case. And I mean, I could talk ad nauseum why I don't believe that your average CPA firm actually is well suited to do what we do. And at a minimum, though, I would say, I had this conversation yesterday with a colleague with a public accounting background, and also who does CFO type consulting. And I think what it comes down to is that the goals of a CPA, a traditional CPA firm, of trying to create a robust service offering that they can standardize and provide a solution that is repeatable over and over again, is the antithesis of what a client actually wants when they're looking for like a CFO service. What the client wants in a CFO service is something that's highly customized, somebody who really learns their industry, somebody who really learns their business, who knows their people, who's interacting with their team at multiple levels of their management team, if not up and down the entire organizational chart of the company. And I just don't think CPA firms are suited for that. They're not designed for that. CPA firms have gone to a lot of trouble over decades and decades and decades to operate within a franchise where, by law, there are standards to how you do an audit, and there are standards to how you fill out a tax return. And they're able to rely on the fact that at some point what they deliver is somewhat standardized and the same across the board. And that's just not, when we talk about all these kind of other types of services, if we're talking CFO type services or controllership type services, they don't fit that model of being something that is regulated into a standard that can be repeated by every firm that you walk down the street and talk to. And I think that's why CPA firms aren't really suited for that work, as well as a boutique firm that has learned how to do that and how to work with clients in that way. So, of course, I'm biased because I don't want the CPA firms to eat my lunch. I want to do my thing, and I want them to do their thing. But yeah, those are some of my thoughts on the survey and the article, and some of the underpinnings of where it might be going.
Yeah, I think you hit the nail on the head, Ty. I think, when we talk about public accounting firms, specifically an audit and tax practice, they are really set up to, and I hate using the word, but churn out audits and tax returns. I mean, you're talking about a very standardized process to do both. Now audits are a little more tailored, and, each client is different and everything, but you're still providing evidence and assurance on an audit and on a financial statement report. So, that is pretty standardized, even though there is some, I guess, flexibility in how and what you do, but it's a standardized product.
Well, I think to me, it's the funny irony of it, because I've worked in many public accounting firms and I know the ins and outs of these discussions, is that what's being pushed on the industry is, with this kind of thought process, is this idea of you got to get into new services, you've got to be value added, and you got to avoid commoditization. But what is ironic and funny about that is I guarantee you the vast majority, your average everyday CPA firm, the minute they get any kind of engagement, what's the first thing they get in the back room and start thinking about how to do? They start thinking about how to commoditize their service in that engagement. How do we standardize this? How do we create processes around this, right? I mean, and look, it's smart. It's a smart thing to do. I'm not saying don't do that or that's not the thing to do, but I'm just saying it's like the nature of the business model. And it's just, that's why they're not fundamentally suited for something that is not supposed to be commoditized.
Well, stole the words right out of my mouth.
In our nature to want to standardize too. It's like such a natural go-to to want to just make everything so easy to repeat and that sort of thing. But yeah, I just want to say I agree with you guys completely. When I think about like kind of the relationship I have with my clients or whatever, and then I think about somebody else from a CPA firm coming in and kind of stealing those services, it's like I don't worry about that at all, because like you said, everything is so customized that it's just it's not something I fear of.
I think, I don't want to give people the wrong impression about my view on standardization because of, you highlighted there, Charlie. I think any good controller who's working an accounting system or an accounting process at any company is looking for how they can create processes that are repeatable. That is exactly what you should do. And so I'm definitely not against that. I just think that you have to although you may want to do that, you have to have an eye for the practicality of when you can and cannot do that, and be designed in a way that you have the flexibility to operate effectively if you can't do that. And I think that's where the rubber meets the road on that topic, is that if you can standardize, great, but are you going to be stopped dead in your tracks if you can't standardize? And I think a lot of CPA firms, that's exactly what happens, is that they get totally like stopped, and the engagement gets frustrated and gummed up in the works because they're not able to standardize certain things. And I think that's where the problem is that you have to be able to do both. You have to be able to standardize where you can to be efficient. No one would ever argue that you shouldn't do that, but you also have to be able to operate when that's not possible. And I think that's where sometimes your kind of everyday CPA firm isn't set up to do that.
All right. So I've got another article we can talk about from Vice.com called Salesforce Doing Layoffs a Day After Announcing Record-Breaking Profits. And so basically one day after having record-breaking profits in its 21-year history, Salesforce has announced that it's going to go ahead and do a lot of layoffs. And I thought it was kind of interesting. They said that a Salesforce spokesperson said that they were helping people find other jobs in the company, but I thought that was interesting because that's not what a layoff is. That's moving somebody to a different department. You usually don't go ahead and like let them out the door and then maybe give them another job somewhere else. But then the other interesting thing is that shortly after making that move, the CEO is on Twitter kind of declaring a victory for what he calls stakeholder capitalism, and bragging about having a record quarter. And there was a tweet in which, maybe it's getting too into the nitty gritty of it, but there was a tweet in which he basically said, he referred to all the people in his company as the Hawaiian word for family, which is ohana, and then said that they should continue to pay their housekeepers and their dog walkers because they shouldn't be worried about losing their job, and then sort of did all these layoffs and that sort of thing. And so I guess there's a lot of kind of outrage about this disconnect between having these record profits and then having these layoffs. But I kind of wanted to take it to an accounting perspective and kind of poke at that a little bit and say that sometimes profitability isn't as not as meaningful, but sometimes it's not as obvious of that the company would not do layoffs as a result of profitability. And so I'm imagining, for example, companies that have huge increases in receivables, so they may have high net income but not good cash flow, and so they're not able, they do layoffs for these other decisions. And so I guess I want to get your guys' take on whether or not you feel that there is a really obvious connection between this idea that I should never do layoffs when I have high profits, or are those two things just not as neatly connected as the article maybe wants them to be?
I don't think they're as connected for perhaps what some people will see as a controversial reason, and I would also, the layoff is like the ultimate of paying zero for or deciding that you don't need that position, right? I think I think I would also lump this together with determining how much you actually are paying people in total, right? So whether, what is the total number of people your company should have versus as well as what is the salary levels of the people that you do have. And my answer to that question is I believe in those questions should be answered based on external market externalities, right? So in most cases, if you're Salesforce, for example, you have developers, you have sales reps, you have support people, you have these different roles which have market rates to them. In other words, whether you work in Salesforce or you work in some other part of the tech community, there is an average salary rate for that role, right? And so I think that companies ultimately, to be successful, they have to identify the roles that they need in the company, and they shouldn't have more just because they have more profits. They shouldn't be carrying extra people that they don't need just because they have more profits. But I also think the reverse is true. Sometimes you have less profits, but you actually need more people because you're growing the business, you're growing the brand. It's not the people's fault that you didn't get enough investment to run this company. And so I think it works on both sides, is that just because your company is at break even or not profitable doesn't mean that your employees should make less than the market rate. It doesn't mean that you should run with a smaller crew than what is needed, causing your what seems like market rate for your people to actually be under market because your people are working more than everyone else in their same job functions. I don't think, and this, I'm not saying this from the standpoint of some kind of altruistic for the employee kind of situation. I'm just saying I don't think you'll be successful in the long run of recruiting and maintaining the best talent that will run your company when you operate like that. I think you have to pay market. I think you have to staff appropriately so that the people on your team don't always feel overloaded. And I think it works on both sides of the equation. I think, like I said, if your company, because of who you sell to or the market that you serve, has lower returns than other companies, that doesn't change anything about what the market rate or the size of your team should be. It just means that as owners, you will take home less profit. Or you might not be profitable if you're still trying to build your brand or build your technology. On the flip side, though, at some point, if the company is wildly successful and it's building and it's actually generating lots and lots of profits, I don't think that necessarily translates into everyone on the team should make more money and everybody, and we should be carrying extra people that we don't actually need to execute the job. So I think it works. I think it works in both directions. I've more often in my career seen it in the lower direction, in the sense of, going back again to my experience with accounting firms. I've heard this from accounting firms who will say, well, we can't pay the same for our staff that a bigger firm can pay for new hires, say out of college or whatever, because the kind of clients we serve not-for-profits or small businesses or individuals. We don't serve larger companies, so we don't make as much money, so therefore we can't pay our staff as much money. That's ridiculous. That has nothing to do with how much you can pay your staff. If you want to have the best qualified staff you can have, right? The resources, there's a market rate for that resource. And that money is, and so you have to pay what you have to pay. It means you as the business owner cannot make as much money because you chose to serve clients that don't pay as much money. That's what it means. It doesn't mean that you get to pay your staff less than other companies in the market who are hiring at the same level. If you want to run an optimal business, right? We're talking about levels of optimization. There's plenty of people out there who will point their finger at me and say, well, you're wrong. I scale my pay to lower amounts because I collect less money from clients and I've been profitable for 20 years. Okay. I'm just saying you're probably not optimizing that equation because you're not getting the best talent and using them in the best ways that you could to generate the most profit because you're underpaying market, and you think that because you collect less money from your customers that's an excuse for that. It's not, and so you see it in other businesses too, right? It's like if you're a startup tech company, a startup of any company, and you want to make a go of it, you have to get enough investment. You have to get the cash on hand that you can pay for the right talent. Saying that you're only going to pay people what you have available to pay them is a recipe for having a group of people who don't have the right skills to move your company forward in the long run. That's just kind of my overall opinion. At least move it forward again optimally. And I've seen it the other direction where it's like, well, we're only going to pay people what we can afford to pay them based on our profitability. As our profitability goes up, we'll pay people more, or we'll have a bigger team. If our profitability goes down, we'll pay people less or have a lower team. The logic of this I'm just going around in circles with my explanation now, but the logic of this just doesn't make sense to me. It just seems that you're acting as if you're operating in a bubble by yourself instead of in a greater market where in order to get access to talent and people, you have to compete like everyone else. You don't have some special privilege to just pay based on what your company can afford. And so, yeah, but the Salesforce question, I don't know enough about their situation, but I would say it could be on the other side of this equation, right? Whereas, okay, they're on the other side. They're more profitable. They have a lot of extra profits, and by virtue of doing layoffs, they determined they didn't need as many people. I don't think there's any obligation for them to keep people on their payroll if they don't need them for their business model just because they're generating profits. I don't think those two things are connected. I don't think it's connected on the low end, and I don't think it's connected on the high end.
I really like your take, Ty, because it was completely different from what I got when I was reading the article. Well, not completely different, but I had a totally different train of thought on this. Well, first of all, it made me feel real old that Salesforce is 21 years old, because I remember when Salesforce was like the new kid on the block, and I feel like that wasn't that long ago, but apparently it was 21 years ago. So, but the other part that I thought was really telling was this article, Vice is showing like record profitability reported. And I think that's a key word to hone in on, because what they're showing is an accounting period that was reported on, a snapshot in time of what the company's profitability was. And what financial management and what Ty was talking about how you manage a business, grow your brand, and attract the best people possible for a position or for your job, has, I wouldn't say little to do, but it's not a financial report. It's planning, it's knowing it's a business strategy, and it's not just a financial statement. And I think often the public get those two confused. And, a snapshot in time of an accounting report on profitability is a good measure, and it's what we use to measure like the stock market and such, and the profitability of a company over a year or a quarter or whatever you want to talk about in a time frame. But it is a snapshot in time. The real like nuts and bolts of managing a company happen, I don't want to say off balance sheet, but they happen outside of a financial reporting. You're trying to look at what's in the future, how you want to grow the business, what type of capital you want to invest in growing the business. And part of that is having good people in place. And so I think, there's a disconnect, I think, in the public's eye. And I don't know as accountants if we've done a bad job, or there's just this, kind of, I guess, illusion that financial statements are the end all be all on a company's like path forward. I think they're a good starting point, but I think if we're talking about the financial management of a company, they're a starting point, and all that stuff happens in different ways outside of truly just an accounting numbers, dollars and cents.
Well, and just to kind of branch off on your point, because I think you're exactly right, AJ, is that like there's not just one uniform measure of profitability. I mean, there's different ways that companies go about determining what their profitability is. One company might look at it as cash flow from operations. You might have EBITDA. You might have a whole nother metric if it mattered in your industry. And so there's not this universally accepted view of what it actually means to be financially healthy. And like you said, it's just a point in time. And then the other thing I was thinking about in listening to listening to what Ty was saying is just that, as an entrepreneur, you sign up because you want to bear the risks and rewards of ownership. You basically say, I want to get into this line of business because I want to make the money there is in that business, and I'm willing to accept the risks of being in that business. And so when you then fill a role and tell the person that he needs a market, a rate that is below market, you're basically passing the risk of being in the industry that you're in onto that person by forcing them to eat that loss. And so it just is a violation of kind of the idea of entrepreneurialism in a way, or at least, that company's implementation of it. And so, yeah, I think it's right on.
Yeah, and I think the other aspect of that is, I think, let's face it, that while at the core, what I'm saying is, the company should be well managed, and it should be managing the resources it needs, regardless of its profitability levels, right? But the truth about that is that management's not perfect, right? And so I think kind of where the fly in the ointment on this is the lack of transparency usually between management and employees about what's going on with the business. And so if you think about it, it's like if I go out in a business and I don't actually need 5 more employees right now, but I just choose to hire 5 more, they probably don't know, unless they're keyed into the financial situation or the business plan. They probably don't know that I'm just hiring extra 5 employees on spec, that I don't actually necessarily need them. So 6 months from now, when I move on and another manager comes in, or when I kind of have a consultant who I'm talking to about this and I rethink it and I realize, oh, I didn't really need these 5 employees. And so then I lay them off. They have no transparency to this, right? There was no reason that when they took the jobs, that they had any reason to expect that they were just like extra capacity that was unneeded, right? And so I think there's this like implied or unsaid contract when you get hired between employers and employees that this company has a real need, and you're going to fill that need, and that need is based on market principles that unless something goes wrong or you don't do the job right, you're going to be you'll have a job, you'll have a reason to be here. If you do a good job, you'll have a reason to be here. But I think what often happens, and particularly in really large organizations, is sometimes that contract is violated in a major way, and that it really doesn't matter how good of a job the employee did, because whether they were actually needed in the first place was questionable, there was no transparency to that point, right? And so it sets these kind of false expectations up with employees as to what value they actually can add to the organization, and whether that value even matters or not. And so I think that's an insidious dynamic in business that I don't know how you really get around it. I think that there's some radical thoughts on getting around it by being more transparent with financials throughout a company up and down the hierarchy, which I don't know if I agree with or not, but certainly that would be one way to address that kind of thing perhaps. But that would presume that everybody had the ability to understand those financials as well and make decisions based on them, which we know isn't exactly the case. So I would say that is one advantage to people in our industry and who we are, is like if we go to take a controllership or a CFO position, people in our situation, in our shoes, I would advise, if you're not doing this, look at the financials, do an analysis of the financial analysis of the company. Ask yourself, can this company do they actually need me? Can they actually sustain paying me? Because if you take that job knowing what you know, with your kind of knowledge and background and experience, if you take that job because it's a high-paying job and you didn't do that analysis, and then you find out later, oh, well, actually the company really could never, it doesn't make sense, the company couldn't really afford me, and you get laid off, you really don't have, I don't feel that sorry for you, right? Because you were expecting something that, you have the ability to kind of foresee that other people don't, right? So I would say, yeah, that's a tangent, but just another thought on this whole kind of topic.
I think it just enforces your overall view, Ty, of accounting and kind of like business in general is the effective deployment of capital, making sure that you're effectively deploying the capital you have available and hiring the best people available with the capital you have to invest in them.
Yeah, I think, yeah, you're right. I do kind of have this mental process that assumes that there is, over the long run, this kind of overarching justice in the world that is determined by correcting markets. But in the short run, it gets muddied by bad decisions across the board.
So we have to believe that. We have to have something to hold on to,
That's Ty's tagline is the effective deployment of capital,
Yes.
All right, I got another article for you guys here. So this one's interesting, and I picked it because our friends over at Westward Whiskey actually suggested it. So it's called Should You Buy or Invest in a Cask of Whiskey? And so I didn't even know this was a thing, but apparently if you're a whiskey drinker, as we are on the show, you can actually invest in your own barrel of whiskey, believe it or not. So what you do is you contract or you take on basically like a wine club or something like that, and you invest in an entire cask of whiskey. And what happens is you invest in this, you let it age, and the reason why you would do so is economy of scale. They have a bunch of essentially barrels of whiskey that they're willing to let you cut in on, and basically you're aging your own whiskey. The thing that a lot of people don't understand, and I guess where the rub is on this, is that when you buy one of these barrels of whiskey, you essentially pay for the neutral grain spirit that goes into it, and the barrel itself, and the aging of that barrel, and the whiskey company makes a small profit off of that, and they get an investment, kind of an early return on their money, in that you're purchasing something that's not ready for consumption yet. And so, but what happens is once that time period of aging has passed, there's a couple things that happens. There's some actual loss of the whiskey itself. When you put in a barrel, a 55-gallon barrel, a lot of that evaporates during the aging process. We're talking about a corked wood barrel that it's aging in, and that kind of, they call it an angel share in the business, that kind of evaporates and soaks out of the product inside of it. The other thing is that once that barrel is ready to bottle, you've only paid up for the aging in the barrel itself. You haven't paid for the bottling process, the bottles themselves. And the other fact is you're probably taking it, any barrel that you're buying is about I think they say it's about 100 in this article. They say it's about 100 bottles. Now that's a lot of whiskey. And so now you're stuck with, let's say it is 100 bottles, but you're stuck with 100 bottles. If you pay the extra fees to get it actually bottled, then you're talking about a large amount of whiskey that quite possibly, even if you gave it as gifts to friends and acquaintances and drank some yourself, I mean, how many bottles of whiskey are you really able to consume out of this cask? And so it begs the question, what do you do with the rest of it? And so a lot of these companies that let you invest in a cask allow you then to sell the remainder of it, using their outlet or whatever, which is again a good deal for the whiskey company itself, because essentially they know you need to offload this stuff and they're able to purchase it from you on the side. So at a discount, I guess, after you've basically paid them to, age and do it. So I kind of like to get your guys' take if this is something you guys were aware of, or if it was something that kind of caught you off guard, and if you guys do think it would be something that you would want to invest in if you're a whiskey drinker. So I'd like to get your guys' take.
It's definitely not something I was aware of, but I think it's interesting because it kind of harkens back to the thing we were just talking about, which is like the risks and rewards of ownership. So it's like, if you really want to, the question to me ultimately is, do you want to be in the business of owning a bottle of whiskey, either for your own consumption or to sale? Not a bottle of whiskey, a cask of whiskey, but it's really a question of, do you want to be in that business, either for your own consumption or to sell it? And so I think that before you really get into this, you have to ask yourself that question. But yeah, I think if you yeah, if you believe whiskey is going to be raising in price, it seems like something that could make sense.
Yeah, I think, this was news to me as well. The idea of investing, owning a barrel of whiskey as an investment. I had heard of people um, getting barrels of whiskey for fun, right? You get the barrel of whiskey, you have it at the house, and you use it for parties or whatever. Or you get the barrel of whiskey and you have it at the office, and you're using it in your firm or whatever kind of thing. So I could totally see that. But I had never thought about the idea of you're buying barrels of whiskey as a form of investment. It's intriguing. It's something I just hadn't thought much about. And then on the flip side, if you're the whiskey company, the distillery, the idea that you might be able to cash flow your inventory early on by selling barrels of whiskey that are not fully aged. I find that as an intriguing idea. And where that goes. So don't have much opinion about it being new to me, but definitely interesting.
Charlie, you got another one for us?
Yeah, I do. It's kind of like what you had. It's kind of an extension of another article. We started the podcast with an article about kind of these cyber attacks that are happening. And so right as we were getting ready to come on the podcast here, I saw an update where from Reuters, Elon Musk confirmed that Tesla's Nevada factory was the target of a serious cyber attack. And so basically what happened is that there was a 27-year-old Russian national named Igorovich Khrushchev, which I'm butchering, but doing my best. But he was arrested and charged with conspiracy to intentionally cause damage to a protected computer by trying to recruit an employee to introduce a malware to the system. And so what the thing I thought was interesting about this is, we're hearing about all these new cyber attacks and that sort of thing. But what he specifically did is he decided that he was going to convince this guy to introduce this malware, but he was going to pay the employee of Tesla $1 million from the proceeds of the ransom that he was going to be able to elicit by doing this. And so it brought this whole new kind of interesting thought into it, which is just that these, basically these cyber attackers can have no capital and still have this basically set up this attack built on the ransom that they don't even yet have. But it creates a incentive that is probably pretty effective, I would imagine. And so I guess it's kind of, beating the same thing we've already talked about, but it's like, I wanted to bring it up mainly for the standpoint of sharing how complicated and how creative these kind of attacks are to really draw attention to it. And yeah, that's what I thought was interesting. So I don't know. Had you guys ever heard of somebody trying to use ransom money to get the company to comply?
Interesting. It's definitely a very 2020 cyber attack, but I don't know that necessarily that I have much more to add to it than that.
I missed what they were trying to get the company to comply with.
He was going to give, so basically the idea is he was going to have malware installed on the computer. So basically he wants a Tesla employee to install his malicious program. And so he goes to that employee and he says, I'll give you $1 million of what we can get from Tesla if you help. And so it's just interesting because it's like, that guy didn't come up with $1 million, and that $1 million probably would have never been paid even if the employee had complied with this person. But it's interesting because now if you think about that, anybody could, he didn't need any capital or any kind of anything to really do this. He just made a promise to some guy, and that guy luckily turned around and called the FBI, but doesn't seem like that would be a uniform reaction. And so, yeah.
Yeah, no, I mean, it's like the cyber attackers are like startup founders, right? They're using other people's money to
crowdfunding
to pursue their idea and their goal, and then paying people with future shares of what they might get if it's all successful, and away they go. Yeah, so it's 2020 entrepreneurialism, like AJ said. Yep.
All right, my last article for today is our favorite topic. The SBA changes PPP loan rules on August 24th, hurting some, helping others at random. So surprise, surprise, on August 24th, SBA issued their first guidance since the 11th. So they waited a whole 13 days, almost 2 weeks, to give us some more information on forgiveness. So Alan Glassman, our boy from Forbes here, gave us a kind of breakdown of what those changes were. So I'll go through them and we'll get your reaction on them. So owner and employee limitations only apply to 5% or more shareholders of S Corps and C Corps. Expenses attributable to a business of subtenant or personal use of home not counted towards forgiveness. So home run businesses, you can't take the business use of home forgiveness for. And this is the one that the most shocking aspect, he called it, of the new IFRs, is that rent paid to a related party is only eligible for forgiveness if, one, the amount of the loan forgiveness requested for rent or lease payments to a related party is no more than the amount of mortgage interest owed on the property during the covered period that is attributable to space rented by the business. And two, the lease and mortgage were entered into prior to February 15th, 2020. So he ends in kind of a conclusion that I think we've all met, is that the SBA continues to change these rules that apply, leaving borrowers and banks that are tasked with administrating the loans wondering what will change next and how they're supposed to submit or accept forgiveness applications with pending litigation in Congress, and rule changes or rules that are continuing to change kind of midstream. So I'd kind of like to get your guys' take on, basically the new developments in the loan forgiveness application, and then kind of, are we going to see more? What do you guys think?
I mean, I guess I would say it seems in line with kind of the idea that they don't want to give the PPP loan money and then have you give it to yourself and call it a business expense and be forgiven. And this is kind of the finer points of trying to implement that by limiting it to the interest, because ultimately that went to some other party. So it's not really going to yourself. And so I guess it seems in the vein of the kind of things I would expect from it, but it does seem difficult that that everything keeps changing, and a lot of these decisions we're talking about would have already been made by now. And so, yeah, it'd be nice to have more clarity earlier on in the process.
Yeah, I mean, I think that last point is obviously always true, but on the flip side, I think we've all known that there wasn't going to be clarity on some things, and that it would take a while to get into it. So I'd say this is one of those issues I don't feel too sorry for people on, in terms of the specifics of what these rules addressed, because I mean, I think that I think that at the beginning of this, you had two choices. You could assume that you should have known, or your advisor should have known. For example, if you're talking about the related party rent transaction, you should have known that this was questionable, that there could be regulation about it. To just say that you had no reason to think that anybody would ever regulate against it just, lacks,
reeks of ignorance.
And lacks credibility, right? So I think that whenever you're dealing with these kind of things, you start with the assumption that you won't be allowed to do it. And, and if the regulation favors you in the future, then so be it. But, if you just ran into it with the assumption of, oh yeah, I'm going to pay myself rent and I'm going to get that forgiven, because there's no rule about it at the beginning, and I'm just going to assume that they won't regulate it against it later. I don't really feel sorry for you for making that kind of assumption at the beginning of it. I mean, it's not how to proceed on these kind of matters is my opinion on that. But I think also, I mean, it's a pretty limited circumstance that you are probably hurt by this, because I think most small businesses, with the extension to the 24 weeks, are supporting their PPP by payroll. So, I mean, you're already kind of in a weird zone where you're probably kind of trying to do whatever you can that's not exactly what this was intended for, if you have a significant amount of your PPP supported by rent and not payroll. And not only is it rent, but it's related party rent to yourself. I mean, when you think about, okay, what scenario is this? And then we want to cry for that scenario for us not making those kind of assumptions at the beginning. Yeah, I'm not feeling it the way the author is. The author is very has a lot of empathy for somebody who might be in that scenario. Not so much. I think they should have assumed that would be the case.
A dramatic way of saying they got exactly what they deserved if they were caught off guard by that.
Yeah, I mean, I don't blame them for trying it. And, and if you're just asking, would it be nice if they could get forgiveness? Okay, yeah, sure. But if you're saying that it's unfair that they didn't know this from day one, I'd say, well, it wasn't reasonable to have vetted all these kind of niche scenarios on day one. And so what's unreasonable is to assume that your niche scenario is going to kind of meet some loophole when time to make the regulations hasn't happened.
I would say I think it's probably PPP is the new clickbait of the accounting article. Like I think a lot of this stuff probably is like, like we said, it doesn't seem unreasonable. And if you were to take a position beforehand, differently, you're probably wishing in one hand and spitting in the other. I think it is kind of, these are really edge case scenarios. If you're talking about owner, a related party rent or something like that, that's below market value or above market value or something like that. They're really edge cases. And I think we're reaching a point with a PPP loan where it's probably a lot of clickbait now, like it's the sexy topic to think out.
So. Yes, absolutely.
All right. I think we did it. We made it through.
All right, everybody. I hope you liked it. We'll be back again next week with more news articles from an accountant's perspective. This has been the None of Our Businesses podcast. Please like and subscribe. Thank you.
See you guys.